A very good day to our lecturer, Madam Sharon, and also our fellow friends. Today we are going to present on EBA4063 Specialized Taxation on the topic of tax implications of cross-border transactions. So now we'll move on to the first part, which is the introduction.
Living in this global economy, it is very common to have cross-border transactions as it is very essential to build up the international market. According to Becker 2019, cross-border transactions are usually referred to a transfer of goods, property or services between individuals or business entities who reside in different jurisdictions. For example, a transfer of buying widgets over the internet from China, and multi-tier joint venture investment structures in another country with complex service and distribution agreements. In other words, it is a transaction in which an international trade between two or more entities outside of the territorial limits of a country, or a transaction in a domestic trade in which at least one of the parties is located outside the country of the transaction. It deals with transactions involving overseas business and investments normally. However, cross-border transactions are often said to be very tricky as these deals can easily raise a number of legal issues on both sides if nautical and tax laws are not followed properly. In fact, cross-border transactions require proper considerations on tax laws of the both countries involved, especially tax-related treaties between two countries, as these kinds of transactions face broader regulatory scrutiny. There are legal and cultural differences that are resulted from the different laws that may affect the different deals, causing the parties involved to be subject to a number of consequences. Therefore, an organization that is contemplating a cross-border transaction must be ready for the tax implications that may raise eventually, or else it will face a number of tax challenges throughout the stages of cross-border transactions. It is extremely important that companies are alert on the multiple international tax and cross-border impacts of their activities in order to strive for excellence in the international market.
I will present on tax implication of cross-border transaction. We notice that transfer pricing is likely to happen during cross-border transaction. So what is it? Transfer pricing is an inter-company pricing arrangement for the transfer of goods, service, and intangible between associated persons, which is common in multinational corporate group or multinational enterprise. It usually comes together with the element of control where there is no bargaining power as they do not deal under arm's length principle. Because of that, we believe that the possibility of tax manipulation is high, as transfer pricing is a technique for associated party to shift majority of their profit to a country that has a lower corporate tax than the others. This situation will result in a loss of tax revenue by the particular company. In addition, we also believe that cross-border transaction will give rise to tax avoidance as far as transfer pricing is concerned. The transaction gave chances for unethical business to re-invoice its transaction so that they can run away from tax payment. Re-invoicing is the establishment of a tax haven corporation to act as an intermediary between exporter and its customer. Thus, the profit of this intermediary corporation and the exporter are accrued to the offshore corporation that will result in minimum or zero tax at the end. Examples of such countries are Bahamas, Panama, and British Virgin Islands, where they usually have no taxes on transactions which involve in imports and exports. Next, cross-border transaction will also result in the occurrence of advanced pricing arrangement, in short APA. APA is an arrangement between a taxpayer and Director General of Inland Revenue, or between competent authority, which establish the transfer pricing methodology to ascertain the prospective arm's length transfer price of specific related party transaction amongst the taxpayer and its foreign affiliates over a specific period of time under specific terms and conditions. APA is beneficial to both taxpayer and the tax authority, as it provides certainty on appropriateness of transfer pricing methodology applied in controlled transaction. According to Weber and Kammer 2020, whether under normal business condition or economic upheaval caused by pandemic of COVID-19, APA may provide more tax certainty to a multinational enterprise. Apart from that, APA avoid the possibility of double taxation through bilateral or multilateral APA, so that all the profits are correctly taxed and allocated. It also reduces or even eliminates the examination of transfer pricing issue during audit, and also lessen the possibility of protracted and expensive litigation. APA helps the taxpayer to better predict the cost and tax liability it incurs, and lastly, it also helps to reduce the resources and time needed for tax authority to examine the international controlled transaction of taxpayer.
For cross-border transactions tax implications, I will talk about withholding tax. Withholding tax is that imposed on non-resident NR who has business dealing in Malaysia. The resident of the Malaysia will be act as an agent. The non-resident will receive a net amount. The resident will pay the withholding tax within 1 month to the Inland Revenue Board (IRB). They will attach sums relevant payments form, together with copy of each invoice issues and the copy of payment documents as proof of that of payment. If this withholding tax is not paid within 1 month, there will be imposed a penalty of 10% based on the gross payment paid to the NR, and this amount will not be allowed as deduction in arriving at the adjusted income of the payer. So now I will talk about the type of withholding tax. The first one that will be the special income of special classes of income. It is means by payment of services rendered by the NR payee, rents or other payments that made under any agreement for arrangement for the use of any movable property. It also can be a technical fees, payment for services, rent, or payment for use of movable property. This payment is deemed derived from Malaysia if responsibility for payment lies with government, state government, or a resident of Malaysia. And under this special class of income, it was subject of withholding tax 10% or any other rate as double taxation agreement (DTA) between Malaysia and the country that NR is tax resident. Now for contract payment, it's a service under a contract. It means any work of professional services performed or rendered in Malaysia in connection with or in relation to any undertaking, project, or scheme carried on in Malaysia, and the payer must, within 1 month after the date of payment, remit the withholding tax to the IRB. And this withholding tax was subject on 10% on the services and the 3% on the services portion of the contract payments account of tax payable by employees of the NR payee. For another one is interest. It will be 50% or any other rate under the double taxation agreement. It will be charged as outgoing or expenses against any income accruing in or derived from Malaysia. And there is some exemption that on the approvement loan to the NR payee, and that the interest paid by the licensed bank or licensed finance company. Another one, for moving next one, is the royalty. The royalty can be copyrights, artistic, scientific works, patent, design, models, plans, secret processes, formula, trademarks, tax for radio or television broadcasting, and motion picture films. It also can be a payment on know-how or information concerning technical, industrial, commercial, scientific knowledge, experience, or skills. For this payment, the withholding tax will be subject to 10%. For the last one is the public entertainers. It is a stage, radio or television artist, a musician, athlete, or an individual exercising any profession, vocation, or employment of a similar nature. For this payment, the withholding tax will be paid on 50% on the gross payment.
Is above the foreign exchange gain or losses. When the company conduct transaction with the other company which located in other country, the currency underlying the transaction might be different from the company functional currency. Functional currency is the currency of the primary economic environment where the company operates in. When the company convert the foreign currency into functional currency, the foreign exchange gains or losses will arise as the value of currency change over time. The foreign exchange difference arises from translation of financial statement from functional currency to presentation currency are neither taxable nor deductible for tax purpose. Underlying nature of the cross-border transaction should be examined carefully to determine the taxability and deductibility of the foreign exchange gains or losses. The transaction should be determined whether they are trade or non-trade transactions. Foreign exchange gains or losses of the trade transaction which also are revenue and interest are taxable or deductible. Foreign exchange difference of trade transactions are not allowed to be taxed or deducted when the transactions are unrealized or capital or both. Foreign exchange gains or losses arise from non-trade transactions are not taxable or deductible. However, there is an exception for non-trade transactions, which is the interest income therefore under paragraph 4C of the ITA and the related foreign exchange difference are taxable or deductible when realized. This is the revenue or capital transactions. Realized foreign exchange gains or losses arise from revenue transactions are taxable or deductible. Foreign exchange difference for capital transactions are not allowed to be taxed or deducted. However, tax adjustment will be made for the realized exchange difference related to the purchase of assets when the company claims for capital allowance. The actual cost of the assets paid by the company is to be used as the clarifying capital expenditure. For example, the foreign exchange gains for the transaction of purchasing machinery will be deducted from the cost in arriving the clarifying capital expenditure. The last is realized or unrealized transaction. Foreign exchange difference of the transaction are considered as realized on the date of settlement. Realized exchange difference will be taxed or deducted. The foreign exchange gains or loss arise from translation of foreign currency for preparation of financial statements are unrealized and not taxable or deductible. The Than that, nature of the borrowings affect the taxability or deductibility of foreign exchange difference arise from borrowings and borrowing costs. The characteristic of underlying transaction will determine the nature of revenue or capital of the realized foreign exchange difference arise on repayment of loan and borrowing costs. If the borrowings are revenue in nature, it is taxable or deductible for the realized foreign exchange gains or losses. If capital in nature, the foreign exchange gains or losses are not taxable or deductible. Besides, the deductibility of foreign exchange losses arise from the valuation of foreign currency also are determined by whether it is a revenue or capital loss. Majority of this type of foreign exchange losses will be capital losses, so are not deductible, except if the business is directly related with dealing in currency.
Next, I am going to present the example of tax cases that involve cross-border transaction in Malaysia. The first case is Alcatel-Lucent Malaysia Sdn Bhd versus Inland Revenue Board (IRB). The services related to global network for voice, data, and video communication was provided by Alcatel International Asia Pacific Private Limited, which is a non-resident company to Alcatel-Lucent Malaysia Sdn Bhd. The issue here is whether the payment made by the taxpayer was considered as royalty and whether it is subjected to withholding tax. Another issue is whether the reference to Section 109 and 109B of the Income Tax Act was unreasonable. After reviewing all the facts and circumstances, the High Court decided that the payment was not a royalty and it was not subjected to withholding tax due to the performance was done wholly outside Malaysia. The application of both rules in the Act was at the same time was also unreasonable. The Court of Appeal agreed with the decision of the High Court. Being dissatisfied with the decision of the two courts, IRB brought the case to Federal Court. The court now ruled in favor of IRB. The reference to both rules at the same time was not bad in law, and the payment made was subjected to withholding tax. Another tax case that involves cross-border transaction is Sdn Bhd versus Director General of Inland Revenue (DGIR). The sector that Sdn Bhd basically involved in was shipping and logistics. During the conduct of daily operations of the business, it had engaged in several transactions with its related parties in other countries and often received commission fees from them. The issues in this case were whether an increase by 0.25% had to be adjusted on the commission fee received by the company as claimed by the IRB, and whether Section 113, Subsection 2 of the Income Tax Act had been violated and penalties should be imposed. The case was to be decided by Special Commissioners of Income Tax, SCIT. After taking into consideration all the relevant facts and circumstances, SCIT ruled in favor of the company. Due to the reliability of the documentation of transfer pricing and evidence of benchmarking, the proposed adjustment on the transfer pricing of the commission rate was to be ignored, and there was no force of law contained in the transfer pricing guidelines. There was also no violation of Section 113, Subsection 2 of the Income Tax Act. The third case involves ABC Sdn Bhd and Special Commissioner Income Tax, SCIT. Taxpayer was a subsidiary in Malaysia of a multinational company, and its main responsibility is to distribute the goods for a related party. An agreement was achieved between the subsidiary and the related party whereby the prices of the products were set based on results of comparable third-party distributors in order to ensure that the price was always at an arm's length margin. The main issue in this case were whether there was mischaracterization of taxpayer based on the result of function, asset and risk analysis, whether the comparable company selected by taxpayer is appropriate, and whether adjustment should be made on the transfer price. The case was to be judged by the SCIT. SCIT ruled in favor of taxpayer. The arguments presented by the taxpayer was agreed by SCIT, and thus the appeal was allowed. The selection of the comparable companies by the taxpayer was also appropriate, and thus no further adjustment had to be made on the transfer. In conclusion, there are both positive and negative tax implications that may be resulted from cross-border transactions. For example, tax manipulation, tax avoidance from transfer pricing, foreign tax losses or gains, as well as better risk mitigation from APA agreement. We believe that if the whole procedure of engaging in the cross-border transactions are managed properly, the negative tax implications could be avoided, instead bring in more advantages to the organizations. The few examples of tax cases, for example the tax case that involves the IRB and Alcatel-Lucent Malaysia Sdn Bhd, as well as another case that relates to the issue of transfer pricing with the involvement of ABC Sdn Bhd and Special Commissioner Income Tax, could all be taken as a reference to better handle the cross-border transactions in the future. With the advancement in technologies and global network, there are many exhaustive yet practical tax solutions being offered to assist the various international tax issues related to the cross-border transactions. Therefore, organizations nowadays need not to worry much to involve in these international transactions of outbound and inbound investment, as consultation and provision of solutions could be obtained everywhere.
I guess that's all from us, and thank you very much for your attention, and I hope you enjoy our group presentations. Bye.